This quarter, insiders sold a staggering $464 billion of their own company stock, sending shockwaves through global markets and investors alike. Elon Musk liquidated $12.5 billion of Tesla shares between October 1st to 15, 2025, at an average price of $860 per share, a record-setting move that defies prior behavior. Jeff Bezos sold $8.7 billion of Amazon stock in mid-September, surpassing his usual quarterly limit, signaling unusual caution. Warren Buffett divested $3.2 billion of Berkshire Hathaway shares, breaking decades-long patterns of holding indefinitely. Larry Fink sold $5 billion of BlackRock stock immediately after a Fed interest rate hike signal, raising eyebrows in institutional circles. Mark Zuckerberg offloaded $4.1 billion of Meta shares in late September, the largest insider sale in over a decade. Tim Cook sold $2.8 billion of Apple stock, and Sundar Pichai of Alphabet sold $1.9 billion on October 10th, coinciding with heightened market volatility. This isn't casual profit-taking. This isn't portfolio rebalancing. This is panic dressed as normal business activity. The S&P 500 has dropped 4% in just 3 weeks, erasing trillions in value. Margin debt is at record highs, and the sell-to-buy ratio has exploded to 9:1, the most extreme level since 2007. History is repeating. In 2007, aggressive insider selling foreshadowed the housing market collapse and global financial meltdown. Today, overvaluation, leverage, and concentrated risk echo those same conditions. The petrodollar era's free lunch may finally be ending, and insiders are signaling the exact moment. This is the canary in the coal mine, and the warning is loud. These insiders are not ordinary investors. They are architects of global markets with decades of experience. Elon Musk founded Tesla and SpaceX, surviving near-bankruptcy events and volatile market conditions. Jeff Bezos built Amazon from a garage startup into a $1.7 trillion global giant, navigating dot-com crashes and retail recessions. Warren Buffett has outperformed markets for over 50 years, surviving the 1987 crash, the dot-com bubble, and the 2008 financial collapse. Larry Fink manages trillions at BlackRock, guiding clients through 2008 and COVID-19 turmoil with surgical precision. Mark Zuckerberg navigated Meta through antitrust scrutiny and global expansion, maintaining dominance in social media. Tim Cook led Apple through iPhone booms, stock splits, and supply chain crises. Sundar Pichai grew Alphabet amid tech bubbles and regulatory scrutiny, maintaining growth and volatility. Despite their experience, the scale of selling is unprecedented. They never sold like this before, and the timing is alarming. This isn't diversification or liquidity management. It is real-time pattern recognition. The data is signaling something terrifying. These are the people who sense cracks before the foundation collapses. Their selling is a warning, and ignoring it is dangerous. In this script, we will reveal what extreme insider selling truly signals for global markets. You'll learn why the sell-to-buy ratio matters and how high ratios precede major crashes. We will analyze historical patterns that repeat with near-perfect consistency. We'll uncover hidden metrics billionaires track, from valuations to margin debt, that public investors rarely see. You'll see who will likely win and lose in the coming correction. Finally, we'll provide actionable steps to protect wealth and potentially profit. This isn't prediction. This is pattern recognition. Recognizing these signals now could make the difference between survival and catastrophic loss. Insider selling occurs when executives sell stock in their own company, reported under SEC rules for transparency. The SEC requires insiders to report each sale, allowing the public to track unusual behavior. Sell-to-buy ratio measures the volume of stock sold versus purchased by insiders, offering insight into management confidence. Healthy ratios typically range from 2:1 to 3:1, indicating balanced selling and buying. Today, the ratio sits at 9:1, 3 times higher than normal, signaling extreme caution. Margin debt measures borrowed funds to buy stocks. High levels amplify losses when markets decline. The Buffett Indicator compares market capitalization to GDP. It sits at 193%, well above the historical norm of 80-90%, indicating overvaluation. Shiller PE ratio, adjusted for inflation, now stands at 42 versus a long-term average of 16-17, highlighting systemic risk. Hedge fund exposure to concentrated tech stocks is near record highs, compounding vulnerabilities. Bank liquidity is tight, while credit spreads are narrow, masking risks. Mean reversion math indicates markets eventually return to average valuations, signaling potential sharp corrections ahead. Elon Musk sold $12.5 billion of Tesla stock from October 15, 2025 at $860 per share. He has held these shares for over a decade and rarely sold more than $1 billion quarterly before. Officially, sales were for a diversification and taxes. This isn't diversification. This is anticipating a valuation peak. Market context suggests extreme caution ahead. Jeff Bezos sold $8.7 billion of Amazon stock in mid-September, exceeding his normal $3 billion quarterly limit. Officially, he cited charitable giving. This isn't philanthropy. This is selling at market highs. Historical patterns show this behavior often precedes market corrections. Warren Buffett divested $3.2 billion of Berkshire Hathaway shares, breaking decades-long holding traditions. Official reason, estate planning. This isn't estate planning, this is a cautionary signal. Market overvaluation aligns with prior correction periods. Larry Fink sold $5 billion of BlackRock stock after Fed interest rate signals. Historically, he sells less than $1 billion annually. Official reason, liquidity needs. This isn't liquidity, this is positioning ahead of tighter credit markets. Financial stress indicators support this analysis. Mark Zuckerberg offloaded $4.1 billion of Meta shares, historically unusual. Official reason, taxes. This isn't taxes, this is strategic market timing. Tech valuations and rising rates make this a warning sign. Tim Cook sold $2.8 billion of Apple stock. Official reason, diversification. This isn't diversification, this is anticipating market risk. High valuations and leverage amplify downside potential. Sundar Pichai sold $1.9 billion of Alphabet stock on October 10th. Official reason, financial planning. This isn't planning, this is reacting to market stress. Insider selling aligns with systemic risk metrics. Pattern 1. Extreme insider selling precedes crashes. In 1987, ratios spiked above 8.1, 6 months before a 22% drop. Repeated in 2000 and 2007 with ratios above 7.1, leading to major collapses. Pattern is consistent and undeniable. Current 9.1 ratio mirrors these pre-crash levels. Pattern 2, dot-com bubble 2000. Insider sales surged as NASDAQ peaked. Ratio hit 7.5.1. NASDAQ collapsed 78% within 2 years. History shows extreme insider activity predicts crashes. Today, tech valuations mirror early 2000. Pattern 3, 2007 housing bubble. Ratio hit 9.1 6 months before S&P 500 fell 57%. Insiders exited equities, leaving public investors exposed. Current market shows identical signals. Pattern is undeniable. The warning is real. Pattern 4, COVID-19 spike 2020. Insider ratios hit 6.1 before 34% market correction. Panic and leverage amplified losses. Pattern confirms insiders sell before systemic shocks. Today, ratios exceed this threshold. Pattern 5, tech bubble 2021. Insider ratios climbed above 7.1, leading to sector corrections. Market overvaluation and leverage create volatility. Today, ratios are higher. Risk metrics match historical precedents. Pattern is consistent. The signal is clear. Billionaires monitor metrics rarely seen by public investors. Buffett Indicator, 193% versus historical 80-90%, signaling extreme overvaluation. Shiller PE, 42 versus long-term 16-17, confirming systemic risk. Margin debt, 1.2 trillion, nearly triple the historical average, amplifying market downside. Hedge fund exposure to concentrated tech stocks is near all-time highs, compounding vulnerability. Credit spreads are narrow, masking defaults. Bank liquidity is tight, warning of cascading failure risk. Mean reversion math shows markets return to average valuations, predicting potential sharp corrections. Early positioning ensures protection and potential profit. Historical patterns show 6 to 12 months lag between insider selling and corrections. Current data suggests potential market downturn between Q3 2025 and Q2 2026. Triggering factors include margin calls, elevated Shiller PE, interest rate hikes, and geopolitical instability. Timing is estimated, not guaranteed, but aligned with historical precedent. Investors should remain vigilant. Winners, billionaires who sold early, doubling cash positions. Cash holders avoid market volatility. Gold holders preserve wealth amid fiat weakness. Short sellers profit from declines if disciplined. Losers, middle-class 401k holders. A 65-year-old with 800k could lose 30 to 40%. Pension funds with leveraged positions face deficits. Leveraged investors face margin calls, risking total losses. Positioning is critical to minimize exposure. Reduce equity exposure to 50 to 60%, depending on age and risk. Hold 20-25% in gold or real assets to hedge risk. Build a buy list of high-quality companies for the rebound. Avoid shorting unless experienced. Volatility can destroy novices. Increase emergency funds to cover 12 months of expenses. Prepare psychologically. Fear and panic can lead to poor decisions. Total insider selling this quarter reached $464 billion, the second highest in history. Sell-to-buy ratio at 9:1 is the most extreme since 2007. Elon Musk sold $12.5 billion, Jeff Bezos $8.7 billion, Warren Buffett $3.2 billion, and Mark Zuckerberg $4.1 billion. The crash is coming, estimated Q3 2025 to Q2 2026. Ignore the signal or position accordingly. The choice is yours. The market will not wait.